Hey everyone. Starting a new project, calling it the BPA project. I mentioned in my interview with Brad earlier that I was reading the books again because I wanted to go back and reread the foundations with a new perspective after having traded for a lot of years. And instead of just rereading it passively, I wanted to go more in depth and actually turn it into a project where I'm forced to sit with the material for a long time and think through it. The first time I read through the books, I read through them pretty quickly, and then I was in Al's room for a long time. So most of my knowledge came from that. So I wanted to return to the books and really go in depth, because I feel like when you're writing something, so in Al's books, every word is much more thoughtful. So it's crafted in the exact way he wanted it to exact way he wanted to craft it. And so I really want to pay attention to those words and the examples and the explanations he gives in the books. Um, and because you learn better by teaching, I thought as a project, it would be a good idea to turn all the notes and everything I was writing for each chapter into a presentation and share them on my channel here, in case anyone finds it useful. I want to be clear that this is all Al Brooks's content, and I'm just giving my perspective on it. And I would still highly recommend that you go directly to the source and purchase and read Al's books and his courses. So I'll share a couple of these as I make them. Just let me know in the comments if you find them useful or helpful, and if you want me to continue posting them. And leave me your feedback and let me know how I can make them more effective and more clear. And also, I just want to clarify that I'm just sharing my perspective on these principles. I'm sharing my perspective, my understanding, and my experience with the principles. So if you have a different understanding of the material, a different interpretation of the material, 100% feel free to share that in the comments, and let me know if let me know your thoughts on it. Let me know your perspective. And so chapter one is pretty short. I should probably clarify that. It's the first book, Trading Price Action Trends. Sorry, Price Action Trends. And chapter one is just an intro about some naming stuff. So I let that go. Chapter two is what I'm going to talk about in this video. So chapter two is about trend bars, doji bars, and climaxes. And the three intro topics are, the first one is assume you can be wrong at any moment. And so the argument Al gives is that anytime you take a trade, there's someone that's equally smart or smarter taking the opposite side. And because his premise is based on 80% or most of the volume being traded by computers, that if you're taking a trade and a computer is taking the opposite side as you, then you have to be willing to accept that you could be wrong. And the point here is that we should never be too convinced of any position. I know when I first started, and I think it's really common with beginners, is that you think you have an 80% chance of making money on a swing because you've seen it a couple times and you think it's very likely. And sometimes I catch myself doing that still, thinking that, oh, this is a sure thing. I know I've seen this before. But you have to be willing to accept that everything lies within a 40 to 60% probability spectrum and never be too certain about your position. And you have to be willing to completely change your premise based on the next bar or the next few bars. And he kind of anthropomorphizes the bars. So you just look at the bars on the chart and you can see what they're doing. And that's just a visual illustration of what's happening with the price transactions. But Al kind of gives each bar agency and intention. If you have a bull trend and you're trying to reach a target and you suddenly get a big bear bar, he'll say the bulls are giving up. They were looking for this target, but now they're giving up. So he's pretty much giving intention to the bars. It's not just, oh, we got a bear impulse. It's that the bear impulse is created by either bulls giving up or bears selling aggressively. He'll also use traps and failures. So if you're looking for 6 ticks and you make 5, he'll call it a 5-tick trap. And if it starts to reverse, he'll say the bulls tried to make 6 ticks, or tried to make 4 ticks. You need 6 ticks above a signal bar to make 4 ticks. So if it only goes up 5 ticks, he'll say it's a 5-tick trap, and now bulls are exiting. So he's seeing everything from the perspective of a rational trader making decisions about how to make the most money possible. And he uses the term strong bears and bulls and weak bears and bulls. And what this pretty much means is that when you look at a chart, whatever happened on that day, if it was a bear swing and then a bull swing, during the bear swing, the strong bears were selling, and during the bull swing, the strong bulls were buying. And at the bottom of the bear swing, the weak bears were selling. So it's pretty much whatever is a losing trade is a weak trader doing it, and whatever is a winning trade is a strong trader doing it. That's pretty much the gist of it. Like, so for example, if a bear trend is slowing down and the new swing lows are being bought, then Al would say that the weak bears are selling new lows because they're not going anywhere. So they're probably losing money selling lows. In other words, you should not be selling lows in a weak bear trend or in a trading range. So he kind of uses strong bears and bulls and weak bears and bulls to signify what you should be doing and what you shouldn't be doing. So if he ever says the weak bulls are doing this, it means that emotional traders or traders who don't know exactly what they're doing are probably going to lose money here. And then finally, this last point is the intro to the chapter, which is that every bar can be seen as either a trend bar or a doji bar. So I'm going to start with talking about dojis and then move on to trend bars. So a doji is when the open of the bar is relatively close to the close of the bar, or it's a sign of two-sided trading. So if you look at it on a lower time frame, the bar will have a swing up and a swing down within the same bar, or a swing down and then a swing up, or it just oscillates around in a tight range. So it's a sign of balance. It's a sign that the bulls and bears are oscillating around a fair value price for that unit of time. And these types of situations are common in trading ranges, and they're common in climaxes, or common after climaxes. So in this chart, I put an arrow above the bars that can be considered to be trend bars, and every other bar in the first couple hours can be called a doji bar because they have obvious tails above and below, and the open is not very far from the close, so it's a sign of two-sided trading. And you can see that this is a very tight range, and within that tight range, there are a lot of dojis because it's a clear sign that the market is undecided. And here, this is an example of dojis after climaxes. So, which we'll talk about in a bit, that trend bars can be considered to be climaxes, but you can see here that we have a big bull trend bar and then a pause, a big bull trend bar and a pause, and a big bull trend bar and a pause. Here I've put arrows above the actual dojis, and you can see that they're coming after the bull trend bars. It's a sign of two-sided trading because after the market has run up for an entire 5 minutes, the bulls and bears are now equal for the next time frame. And that's happening because we've run up so much in this 5-minute bar that now the bulls are hoping to buy a pullback and the bears are selling expecting a potential pullback. When that doesn't happen and we instead go sideways, it shows that the bulls are holding their ground, and if the bears give up, we'll get potentially one more climax, and then that process will repeat itself. If after the climax the bulls are waiting to buy a pullback and the bears are selling hoping for a pullback, we'll get another pause. And then finally, the bulls overwhelm for one last time and get one more bull bar. And now, if there are signs of two-sided trading all the way up, at some point, the bears will feel like they have control and they may overwhelm the bulls for a couple legs down, which is what we got here. And so although dojis are common in trading ranges and they're trading range bars, they can also signal a trend. And so you can see here, I have this group of bars marked off with the arrow. Here we had a breakout above the moving average and a wedge bull flag. And we broke above the moving average, but not strongly. But during this time period of 5 or 6 bull bars, we had higher highs, higher lows, and higher closes. In a couple areas, we had equal lows and equal highs, but overall, we had a micro channel, and we had every close above the prior close. So that's a sign of trending dojis, and it could be a streak or a sign of buying pressure that leads to an upside breakout. So here, even though these could be all considered to be dojis, it could be signaling a start of a breakout. The same is true here. We had a tight trading range. This is the same chart I showed earlier. We have a tight trading range, but eventually, you can see throughout this tight trading range, we're alternating bull bars and bear bars. We have 2 bull bars here, but then we went sideways. Here we had a bull breakout, but a bear doji. Here we had a bear bar, but a bull bar, and then a bear bar that followed it. But here, starting at bar 21, I'm not sure if you can see the numbers, but you can see my cursor is above bar 21. we started to get consecutive bull bars, and they started to increase in size. But most of these are dojis, and eventually, when the buying pressure builds up in the form of dojis, it could signal a bull trend. And I'm pretty sure I was in the room this day, and Al said he bought somewhere at 25, 26, or 27 because of this streak, because of the trending dojis. So that could be a sign that a trend is starting. Now we'll talk about trend bars. The trend bar is defined as a close that is a relatively large distance away from the open of the bar. And it should have a moderate sized body based on the average range of bars. And I showed that in the prior charts. A sign of strength of a trend bar is when the body is larger than the median of the last 5 to 10 bars. And a sign of strength for a bull trend bar is when it opens on the low and closes on its high. So here, for example, bar 28 opens on the low, closes on its high. 29 opens on its low, closes near its high. 37 opens on its low, closes near its high. Those are signs of strength for a bull bar. And the high or close of a bull bar is above the high or close of many bars before it. So in this chart, you can see that this green arrow is showing this strong bull bar. I don't have the yesterday's price action, but it was a larger wedge bull flag, and we got a really big bull bar closing above the moving average, closing above the last 15 bars, and closing on the high. Those are all signs of strength. That, combined with the follow-through bar after it, formed a small spiking channel that stayed above the moving average for 20 bars. So that is a sign of a strong trend bar. The other glaringly obvious trend bar here is bar 36, which I've labeled with a red arrow. It's clearly bigger than all the bars before it, and this is closing below the last 30 bars. So it's a strong bear bar. It opens near the high, closes near the low, and closes below many bars before it, and has a low below many bars before it. That could be a sign of a successful breakout and a measured move down, which is what we got here. Al says that the most important skill for a trader is to know when a trend bar is a pullback, when it is in a trading range, and when it's a successful breakout. So knowing when a trend bar is going to signal a trend, or when it's exhaustion, or when it's within a trading range is one of the most important things that we can do as traders. He says every trend bar is simultaneously a spike, a breakout, a gap, part or all of a vacuum or climax, and a sign of buying or selling pressure. I'm going to go through each one of these. So my interpretation of what Al means by every trend bar being a spike is that a spike is a bar or a set of bars that could lead to a measured move or a spike in channel trend of some kind. And on the given time frame, every bar could be a spike for a potential channel or a spike for a potential measured move on a lower time frame. So here we have an obvious one, 15, 16, 17. It's a spike down after an opening range breakdown, double top here, double bottom. We got a strong breakdown that led to a spike in channel. But even bar 20 here is a spike and a channel on a lower time frame. So this bear trend bar is also a spike, and it did get a channel that followed. Bar 28 here is a bear bar. It also got a channel, a parabolic channel. It got a move down to 29, 31, and then finally a failed breakout on 32. So every bear trend bar is an opportunity to get a spike, is a spike for an opportunity for a measured move or a channel down. And so if you look at every trend bar that way, you would see that there's an opportunity for a channel to continue or a measured move, but it's the context that determines if the spike is actually going to lead to something or if it's going to be a failure. And so Al also says that pullbacks are often spikes in the opposite direction of a trend, making traders think that the trend is reversing. So this arrow right here is showing one bar, a strong bear spike against a bull microchannel. And he's saying that we often get spikes or strong bear bars counter trend that makes traders feel like the trend may be reversing, but most bulls will buy the bear spike, betting that it's just a pullback. The second time we see trend bars is with breakouts. And all trend bars are attempts to break out of something into a new trend, but most breakouts fail. And so to me, this means that every trend bar is a sign of imbalance. And it could be the start of a new move into a new area of agreement that is far enough away that it could be considered a swing trade. So for a bull trend bar, it means that for a breakout to succeed, the market would have to travel 2 times the initial risk of the trade at least 40% of the time, or reach some kind of measured move target. And most trend bars don't initiate a new trend of this magnitude, and therefore can be seen to fail. So every trend bar is trying to break out of the prior bar's high, it's trying to break out of a swing high, and most of those are not going to go up for a swing and initiate a new trend before going below that trend bar. And so most of them can be seen to fail. And so most trend bars don't lead to a swing of that magnitude, they don't initiate a trend, and they fail much quicker. And so a lot of experienced traders will fade breakouts, betting that they'll fail because it's much more common, especially in a trading range, and especially against the trend. So here are a couple examples of breakouts. The green arrow is showing a breakout of a prior high above the bar 1 high that did succeed in creating a new trend. But then this white arrow is showing a bear trend bar that tried to break below this tight trading range in a bull trend, and we did not initiate a trend with it. We actually went above it and continued the trading range. This bar that has the red arrow pointing to it, it ended up leading to a trend down. It's more likely a bear leg in a trading range, but it did not go above the high and did lead to a measured move down. So that's one of many trend bars that led to a trend, but every trend bar in between it is not initiating a new trend, and most do not. Here's this bear trend bar that I have with the white arrow is showing that we tried to break out below this range. It was a second bear climax and eventually failed and went above its high. And same here. Now we're in a trading range. We're trying to break above the moving average. This is a bull trend bar trying to break above the moving average, trying to break above this double top, and it failed a few bars later. So most trend bars are going to fail and not lead to a new trend. And so, especially in a trading range, experienced traders will fade those breakouts. So breakouts typically fail, but when they're breakouts against the trend, there's a much higher likelihood that they're going to fail. And when you get a spike in the opposite direction of a trend, it's more likely to be a pullback. So it's a very high likelihood that the breakout will fail. Usually those spikes against the trend, the breakouts against the trend, they usually have no follow through and they become pullbacks. And so experienced traders will buy them, either buy the close or start to scale in, betting that we'll get a new extreme within the next few bars. So I showed this chart earlier. This is a breakout, making traders think that we're climactic, we're getting consecutive climaxes, and now we're getting a bear spike that could lead to a spike in channel or a new trend. But so inexperienced traders will sell here. They'll sell during the bar, they'll sell below it, thinking that we might be reversing. But experienced traders will bet that breakouts fail and breakouts against the trend are more likely to fail. And so they'll be buying here. I'm saying inexperienced traders will sell here. I actually did sell in the next chart I'm going to show you below 19. So here, this arrow is pointing to bar 19. I actually did sell below bar 19. This was not that long ago. This is a year ago. So that's pretty bad. But I was seeing this as a breakout, a second leg up, and consecutive climaxes after a gap up. This was not consecutive climaxes, and it was a very bad sell. But I sold there, and I was able to get out break even. I sold there, and I sold more higher, and was able to get out, I think, with a small profit. But it was just a really bad trade. And reading this again reminded me, Al says, inexperienced traders will ignore the trend and just think that this bear spike is going to lead to a breakout, but it's not. And this is actually buy the close, and this is something that I try to do now. This bar is buy the close, not sell the close. So these breakouts against the trend, especially in a micro channel, especially in a very tight channel, are probably going to become pullbacks. And so expect the breakout to fail. So that was breakouts against the trend. Now we'll look at when is it likely for a breakout to actually initiate a trend. So for a breakout to initiate a trend, it shouldn't happen. So we shouldn't get a bear breakout in a tight bull channel. It should be coming from an area of two-sided trading or agreement. So a breakout that initiates a new trend will typically come out of a trading range or out of two-sided trading. It should have strong follow-through, and if it does have strong follow-through, it increases the chances that it leads to a measured move target or 2 times the initial risk. So here, this green arrow is showing that we had a high 2 buy, second entry buy after a gap up. This is not a great signal bar, but we got a strong breakout and then follow through buying on the next two bars. This is starting to show signs of a spike for a potential spike in channel, and it's showing that we could potentially get a measured move up after the strong buying pressure. So breakout, follow through, and then continuation is a sign that the breakout could be leading to a new trend, and it did. That's what it did here. Now, after these 7 bull bars in a row, many of them closing on their highs and strong bull bars, we got this bear spike in the opposite direction. This is considered a bear breakout. It's breaking out below the low of this bar, below the low of the prior 2 bars, and it's trying to start a spike in channel and break out to the downside. But we're clearly always in long. This is a tight bull channel. It's a micro channel, so this breakout will probably fail. So you'll have bulls buying 10 points below the doji or buying that close, betting that we'll get a new extreme and that this breakout will fail, which it typically does. Now this breakout here, it's 2 consecutive strong bear bars. It's coming after two-sided trading. This is a major trend reversal. Al talks about that in book 3, so I'll talk about that then. But these breakouts are coming in a tight bull channel with no sign of selling pressure coming before it. Here we had signs of selling pressure. We came down to the moving average, got a test of the extreme, and now we're getting a really strong breakout with follow through below the moving average and below all of this. So this increases the likelihood that we're going to initiate a new trend. Whereas this breakout here and this breakout here are happening in a tight channel and more likely to only lead to sideways and a new extreme. So as I mentioned here, we talked about spike and breakout. Every trend bar is also a gap. I'll talk about this very briefly because Al talks about it, I think, in book 2. But when you have a gap up on the daily chart, on the 5-minute chart, this gap up exists because there was an imbalance overnight. So there was so much imbalance that there was buying throughout the night that the market opened up here. And so all that buying is pretty much a giant bull trend bar. And that's why he sees a bull trend bar or a bear trend bar, any trend bar, as also being a gap. It's a sign of imbalance. And so every gap can be seen as a trend bar, and every trend bar can be seen as a gap. And so the fourth way to interpret a trend bar is that it's part or all of a vacuum or climax. And so one trend bar can be a climax because if you think about it, one 5-minute bar is 60 5-second bars. And so even though you have one big bull bar on the 5-minute chart and it looks like it's just starting, on the 5-second chart, it's been trending for 60 bars. Or on the 15-second chart, it's been trending for 20 bars. So it's already been trending for quite a while on the lower time frames. And so if it's a climax on the 5-second chart, it's also a climax on the 5-minute chart. But the effect won't be as obvious on the 5-minute chart. So it may pull back for 20 5-second bars, which is just approximately a minute and a half on the 5-minute chart. So it won't show up as obviously, but it can still be seen as a climax on the 5-minute chart. And so this chart from earlier is a good example of that. We had a bull bar and then a pause, bull bar, pause, bull bar, pause. So every bull bar here, it's just a 5-minute bull trend bar, but it's 60 5-second bars and it's been trending for a long time on the lower time frames. And so that manifested as a pullback on the 5-second chart or on the lower time frames, which manifested as a doji on the 5-minute chart. And so after every trend bar, it acted as a climax and needed a pause, climax, needed a pause, and climax, needed a pause that eventually led to a couple legs down. The strong bull trends have multiple climaxes, but most of those climaxes are not climactic tops. And I think that's extremely important, especially for beginners, especially for me right now, because I've been doing a lot of this fading strong trends. But I think it's important because every trend looks like it's gone too far, but just because it's a climax doesn't mean it needs to reverse. It just means that it may need to take a break, and that could just be a couple bars sideways. So just the fact that we're getting climaxes does not mean that we're going to get a reversal. Climactic tops are talked more about in book 3, so I'll save it for that. But it's essentially a climax that then leads to a reversal down. But most climaxes don't lead to reversals. They lead to more movement in the direction of the trend. So the third point here is that a pause ends the climax. So a pause, as we mentioned earlier with doji bars, is a sign of two-sided trading or slowing down. And so a pause ends a climax, and that's important because here, for example, you have 25, 26, 27. It's a 3-bar climax. So this this pause, the bear bar, ends this climax. And so if you're getting climaxes of this size, then you might get a much larger trend than if you're getting climaxes of this size here. So here you're getting breakout and pause, breakout and pause. So the climaxes are ending after 1 bar. Whereas here, the climaxes are ending after 3 bars. And so even if we get 2 or 3 climaxes on this chart, even if we get 2 or 3 climaxes on this chart, it could go a really long way because every climax is 3 bars long or 3 bars tall. So the pause ends the climax, and that's important to know because that's going to tell you potentially how far the move can go. If the climax is 3 or 4 bars tall, we could be going a long way. So if it's going 4 bull bars in a row and then a pause, and then 3 bull bars in a row and then a pause, then this could be a very, very strong bull trend. The pause in a bull trend can be a small bull bar, which just shows signs of slowing down, a doji, which is two-sided trading, a large tail on top, which is a strong pullback on that bar, an inside bar, which is potentially a triangle or a pause or a two-sided trading, and a bear trend bar, which is a sign of a pullback. So those are situations that would end the climax. This is important because Al talks about this often, that you're looking for, especially in trading range days, you're looking for 2 or 3 legs up, 2 or 3 legs down. And so if the pause is telling you that the leg might be done, that it's the end of a climax, then if you get 2 or 3 legs down that's separated by pauses, then maybe that's time to stop selling and maybe look to buy. And so here we had the 3 bars up, a bear bar, and then 3 bars up, big tail on top, inside bar, 2 strong 2 bar breakout, 2 strong bull bars, and then a bear body. That's a pause, and then another strong breakout, another pause. You can see from this arrow here onwards that the pauses are starting to get more significant. So here it's a tail and a doji, but both bull bodies. Here it's a bear bar closing on its midpoint. Here it's a strong bear trend bar. And now the bear trend bars are starting to get bigger. And so this is a sign that the bull trend is waning because the pauses are starting to get more significant. The bears are starting to have more of an impact on the bars as the trend continues. So the trend is weakening. But this is important because now that we have 1 climax with a pause, 2 climaxes, pause, 3 climaxes, pause, 4 climaxes. After 3 climaxes, it's starting to get overextended. And if the bears are willing to sell here and form two-sided trading here and form two-sided trading here and here, eventually the bulls will step aside because the price has rallied so far in so little time. And the bears will start to take over, not necessarily for a reversal, probably not a reversal, and more likely a couple legs down, which is what we got here. And we eventually got the reversal on the next day, but just for this chart, it was a double top bear flag and a second leg down. Here's an example of a bear trend. We have the breakout on 7 and then 2 bull bars, and then an even stronger breakout here on 10, 11. And this is a smaller body, which means that in this 5-minute time frame, it went a lot slower. That can be a sign of a pause. And it makes sense that that was a pause because then we got an equivalent second leg down from this 2-bar breakout. So 2-bar breakout, pause, that ended the climax. Another 2-bar breakout, and now a bull trend bar. That ends this climax. And then finally, 1 more big trend bar on 17. So that it's 1, 2, 3, 4 climaxes down. And now we're starting to get a lot of bull bars. So now the bulls are willing to step in more aggressively. And we went sideways for the rest of the day. Eventually, after this final flag and breakdown, we got 2 legs up to end the day. So these pauses are important because they give signs that the trend may be weakening, and when the pauses become more bullish in a bear trend. So when it goes from a pause to a bull bar to 3 bull bars, now the pauses are actually getting stronger. The bulls are exerting themselves more, and that could be the sign of a trading range forming and a potential major trend reversal. Whereas if this was just 5 bars down, or 5 medium-sized bars down, that could be the first leg down. And we could get a small pause and another 5 bars down. So that would be a sign of a very, very strong bear trend. Whereas if we're getting pauses on the way down, it shows signs that the bulls are willing to step in on the way down, at least a little bit. This chart I've showed many times. This is a trading range. And so this is useful in trading ranges because we have a second leg up And on the second leg up, we know we have 3 climaxes up. So the bears stepped in there, they stepped in there, they stepped in there. And you can see every doji is more bearish than the prior one. This is a bull body, this is a small bear doji, this is a slightly larger bear body. And so the bears are stepping in higher, more aggressively as we get higher in this trading range. And eventually they take over for a couple legs down or move down to the moving average. This is very common in trading range days where each leg is very small and separated by a pause. Here's a similar situation. Big move down, strong move up. This is the second leg up. We have a rally, a big tail, another strong breakout, pause, breakout, and that led to a move down for a couple legs and tested the moving average. So second leg up in a potential trading range day, and you can see that this has 3 clear legs. So the bears are willing to step in on the way up, and eventually when we get high enough in the trading range after 3 legs up, they're willing to step in more aggressively, and the bulls step aside and look to buy closer to support, which is the moving average and this breakout point. Again, same example, potential trading range. The high of the range might be bar 21 up here as a potential lower high. We have a breakout after a tight bear channel. We have a breakout, pause, and then now we're on the second leg up and we have strong bull bar, doji. That shows that this bar is acting as a climax and it ends the climax. Second breakout, pause, and then third bar went up and down. That's a climactic reversal top on a lower time frame and led to a couple legs down on the lower time frame, and bulls stepped in at the breakout point and the moving average. So these pauses are important to keep an eye out for, especially at support or resistance in a trading range day, because it could mean that the leg is completing and that one side will step aside. And so when a climax is followed by a reversal, and we talked about climactic reversal top, when a climax is followed by a reversal, it's usually because of the vacuum effect. And so the vacuum effect is that instead of one side being enthusiastic, it's actually traders stepping aside waiting for obvious support and resistance. So here, for example, we have a major trend reversal. We're at the top of a bull trend, and the bears are getting a chance to sell enthusiastically at a premium price because bears want to sell high. And so they're getting a chance to sell high up here, betting that the trend will reverse. And they're overwhelming the bulls and creating a strong breakout. That would be an example of bear enthusiasm. That's very different than a situation like this, where if everyone's in agreement that we have to test yesterday's high, which is this white line, and it's happening late in the trend, then bears who are short here will think, if we're obviously going to yesterday's high, why take profits and cover shorts until we get to yesterday's high? And if bulls believe that we're probably going to test yesterday's high, why buy up here? Once we get close enough to it, why buy up here when you think we're going to get down to the yesterday's high? So when we get close enough, if everyone's in agreement that we're probably going to test the price, then bears don't exit their shorts until we get there, and bulls don't start buying until we get there. And as soon as we get there, everyone buys aggressively. Bears buy back their shorts aggressively, bulls buy aggressively, and that ends up being the bottom. And it looks like it's surprising because the bears are so strong. But this is not enthusiastic bears selling aggressively to initiate a trend. It's actually bears just waiting to take profits at a specific price, and bulls waiting to buy at a specific price. So same situation here. We're at the bottom of the trading range. This bear breakout, it looks like it might be breaking out of a wedge bull flag and breaking below the low of day for a measured move down. But it's also possible that when we got close enough to the low of day, bears didn't want to take profits until we got there. And when we got close enough, bulls didn't want to start buying until we got below bar 1. And as soon as we got that bar, it's actually just a climax and a sign of the vacuum effect of everyone waiting for this price at this level. It could also be a moving average it could be the 200 period moving average on the weekly chart. It could be some obvious level that everyone's waiting for. And when we get close enough to it, everyone just waits for it and then starts to buy aggressively. And the last point for trend bars is that it's a sign of buying and selling pressure. So buying and selling pressure is cumulative. And that means as selling pressure, for example, builds in a trading range or in a bull trend, it increases the chances of the bear trend. So here, I mentioned this first bear bar is the first bear bar in a tight bull channel. But as we rally, we start to get more and more bear trend bars. And that's a sign that bears are stepping in more aggressively. Eventually, when we pull back for the first time and then test the extreme, now that we've shown that there's signs of selling pressure, the bears may step in more aggressively and take control of the market. And so the signs of selling pressure building are the increase in number of bear trend bars, the increase in the size of the bear trend bars, and the increase in strength of the bear trend bars. So increase in strength means that they're opening closer to the highs and they're closing closer to the lows. So here we had one decent sized bar here, but it had a big tail on the bottom. And then here we had dojis, bear dojis. But here we have a strong bear trend bar closing near its low. And now we're getting a lot more bear trend bars. So the amount of trend bars are increasing, the amount of bear trend bars closing on their lows are increasing. And eventually we get the strong breakout. And here is a good example of the bull case. Here I was showing the pauses, but if you look on the way down, we have five strong bear trend bars, and you get the first bull trend bar here. And as we start to sell off more and more bull bars start to show up. The quantity and the size starts to increase. Here on the way down, we had very small bull trend bars. Then we got the breakout, and we're starting to get a lot more bull trend bars near the lows. Bulls are starting to step in a lot more aggressively, and that's eventually what led to the two legs up. So in this case, the trend bars showing up here are the signs of buying pressure, and that buying pressure is adding up. More and more bulls are willing to buy. And that's an important purpose of a trend bar, is that when you see more and more of them coming in, it's a sign that that side is starting to exert themselves more. So that's chapter 1 and 2. Please let me know your thoughts. Let me know anything. Let me know if it was useful, if it was helpful, if you have any feedback, if you disagree with any of my interpretations of the principles, and if you'd like me to continue posting these for all the chapters. Anyways, thanks for sticking around and watching, and I hope it was helpful.